Hello, everyone, and welcome back to the new Blueprint strategy course. As you know, fundamentals can tell us if any market around the world is set up for a major rally or decline. And for most finite markets, we want to focus on the COT as the primary setup and forecasting method. As you know, finite markets are markets where the lifespan is pretty short. Gold, for example, is a resource that goes from users to producers because gold is mined and then made into jewelry or computer chips. Chocolate, for example, is a finite market because it's made into cacao and then it's all over. Therefore, it makes sense that the users and producers are the most important group for us to follow here. A very good example here is Palladium, which we analyzed the commercials on. And based on the commercials, multi-year historical extreme and accumulation, we forecasted a major rally in Palladium. If you want to go back to the date when we looked at this, this was 4 sessions ago or 5 sessions ago. If you look at today's session, that was this one right here. And here we said we will look at Palladium, which based on the commercials alone presents a major buying opportunity. So if that doesn't ring a bell, you can go back to this video and look again at Palladium and the analysis. And to date, if we're going to go to Palladium, even though it's down today, already started to rally quite a bit, right? From the last few weeks. This is when we looked at it. And then a few weeks later, we can see that prediction, that forecasting model on the commercials really played out very nicely on Palladium. Nonetheless, as you've also learned, we can also apply the COT to our infinite markets and man-made commodities, where we looked at the non-commercials to predict major trend changes in the euro. We looked at the US dollar and we looked at the Japanese yen. However, there are still 2 open questions here, really. What about stocks and equities? These are not futures markets, and therefore we can't use the COT, right? And even for futures indices, where we could use the COT on, the question is, could there be better, more effective and consistent ways of forecasting our infinite markets that would include our equities, our stocks and equity indices? Well, if we look at some traditional methods, there are many ways on how value in equities is usually measured. Traditionally, value in stocks may be measured with dividends, it may be measured with price to sales ratios or PE ratios. But today, I believe that the most important fundamental driver for stocks can be found when looking at the interest rate market, the US bonds and treasury market. And this is where the campus valuation indicator comes into play. Here we'll look at cross-market conditions, or in easy terminology, we will look at the bond markets to understand whether a stock is under or overvalued. So in the last 4 lessons, we covered the COT on the finite. And now we're going to jump on the valuation for our infinite markets. However, the COT can also be applied on infinite markets, and the valuation can also be applied on finite markets. However, for each of our markets, we will have to focus on one as a primary and one as a secondary fundamental forecasting tool. So today we will focus on stocks and bonds. And the next time we will then move on to how to use the valuation method on Forex and also on some commodities as well. So we all want value for money. But what is value? And how can we get a sense of value for all sorts of stocks and equity indices alike? What we're going to have to do is we have to look at the relationship of a stock and interest rates. And what usually happens is that there is a specific spread in terms of how close together or far apart these are. And I believe that interest rates have an extreme influence on the prices of stocks. Therefore, what we want to do, we want to compare the price of any stock on a ratio to interest rates. And this would give us then an indication of whether a specific stock is priced relatively low compared to interest rates, or in other words, undervalued, or whether a specific stock is priced relatively high compared to interest rates, here in red, overvalued. And this relationship, or in the world of indicators, we would then speak about a relative spread between stocks and bonds, create these overvalued and undervalued readings. And our indicator would then show this in the form of an oscillator, where high readings in red here would be overvalued or bearish market setups, and green readings here on the screen would be undervalued or bullish market setups. There are some key points I want you to note down before we get into the practical applications, which we will do plenty of on the valuation tool. Number one, the Campus Valuation Index, or the Campus Valuation Tool, or just Campus Valuation, just like the COT, they are not timing tools. Okay, they are fundamental setup tools. Remember, if a market sets up fundamentally, it doesn't just mean that we will then go in and just buy or sell that specific market, be it a commodity or a stock or an equity index. Rather, what we want to do once the market sets up, we will overlay our technicals, mainly supply and demand, to then time the markets effectively to get in and out of markets with good risk to reward propositions. So number one is, it's not a timing tool, it's a setup tool. This should sound familiar to you, however. Number two, stocks relate to interest rates. Yes, absolutely. And I'll show you that in just a minute. However, not all stocks do. Okay. I found that most stocks that are comprised within the major US equity indices, especially the ones with a higher weight, like Apple, Google, Microsoft, Amazon, you name them, they're the ones that seem to be influenced by bonds the most. Also, bonds seem to impact equity indices around the world, but mostly the US ones, which are also the ones that we focus on in our analysis. So number two is, interest rate influence stocks, but not all. And lastly, I want you to note down that there will also be stocks that there is little or close to no relationship between bonds and the price of the stock. Therefore, when we use this indicator on any stock or on any equity index, it is going to be your job to backtest prior overvalued and undervalued readings to get a general sense or understanding on how well this works in terms of its accuracy. And here we can follow a similar table we followed for the wheat market backtest here, and we can just do a backtest, which we will do together on stocks to see which stocks show a high accuracy and how high that accuracy is, depending on the market direction condition. All right, so plenty of things we already noted down. We noted down that the valuation is a setup tool, not a timing tool. We noted down that not all stocks relate to interest rates, just some do and some don't. Some do extremely well. Some show a very high accuracy and some show a very bad accuracy. So it's our job to pick out the ones where this really works well on, and that makes sense as well. And now jumping to the next topic, there are going to be these cycles that we want to look at. And before we go into the practical applications, let's just cover some cycles that I found are the most important to the stocks and equity indices that we cover. I found that for most stocks, there are two cycle periods that work especially well. On the weekly chart, we can use the valuation tool, of course, as well. And there is the 13-week cycle that seems to have a high level of importance and show high level of accuracy. If you think about that for a second, that makes a lot of sense, right? Because the 13-week cycle are quarters in the year, and quarters are earning reports. So earnings, we know, are important fundamental drivers for stocks. Therefore, when we use valuation on the higher time frame on a weekly chart, we will use a 13-week cycle, and that will give us the end of bands. So this is our counter trend strategy, or our anticipatory trend strategy, where we predict a downtrend to go into an uptrend, or we predict an uptrend to end and go into a downtrend. On the daily charts, when we find strong trends, we can use a 30-day cycle or a 10-day cycle. Oftentimes, they both work hand in glove similarly well, but there are these two that we can use. Generally, the higher you go in terms of the cycle, the more accuracy you should get and the less setups you should get. Meaning the longer term your trades are that you potentially find. So if you find something on the 10-day cycle, that's a shorter term setup based on valuation. If you find something on a 13-week cycle setup, that would overrule the 10-day and the 30-day cycles, as the 13-week cycle is the highest fundamental time frame that we would use on our infinite markets, on our equities. And the lower time frame daily charts, the 10-day and the 30-day cycles, they would then be the base of our trend following strategy. As you can see here in the picture, when something is trending, we really want to look at the undervalued readings as opposed to the overvalued readings, as we look at the daily chart on the Nasdaq here, for example. And if you're gonna look for undervalued readings, and in fact, we stay undervalued, and then we get nice rallies, and then price rallies, and even after rally, we again get undervalued readings. We again get a nice rally. We get undervalued readings. We get a nice rally. We get undervalued readings. we get a nice rally, we get undervalued readings, we get a nice rally, again, we stay undervalued, and then we get a nice rally into new highs. So already looking at this little screenshot here, this would be 100% accuracy based on this tool, right? This is the time frame of roughly a year from July to July. And within that time frame, we set up a few times, and every time we set up, this also coincided with a very good time to buy the Nasdaq as we look at this relative spread between how the bond market moves and how Nasdaq moves in this example. Of course, as we will look at that at a bigger sample size, not just a year, as we look at, for example, 5 years of data, this will not be 100% accuracy. Nothing that I will ever show you is going to be 100% accuracy. However, this is the best there is for infinite markets. So we have an end of the band strategy, and we have a trend following strategy, just like we have for the COT. And the end of the band strategy is going to be based on weekly charts and 13-week earning cycles. And the lower time frame trend following strategy is going to be based on daily charts, and it's going to be 10-day and 30-day cycles. What you will notice on the indicator is that you will have a number here and a symbol here. And the number represents the cycles based on bars. Since this is a daily chart, it will be 30-day cycles. And here the reference is at US. So that's our 30-year Treasury bond market, which has the highest influence on stocks. And so already by looking at this, you will see that, okay, we're looking at interest rates and we're looking at a 30-day cycle. On this specific example, this is how you can cross-check my charts against your charts when you follow a live trading session and you watch a recording, and your tool on your end may look different. This is how you can check the cycles to make sure that you're looking at the same cycle, and then you should also get the same result on your end. But we'll set up the indicator together in just a second. So we have a strategy to predict the end of the band, and we have one to follow the trend. Okay. So generally within this oscillator, regardless of the cycle period and regardless of whether you look at daily or weekly charts, you will always have an oscillator that will give you two boundaries. It will give you a red line, the 75% line. You can also change that, by the way, but we just put it as 75%. And you have a lower boundary as the minus 75%. And whenever this oscillator goes below this green line, below the green boundary, then this market would be undervalued. We'd look to buy. This would be a bullish fundamental setup. And whenever this oscillator goes above the upper boundary, the red boundary, the 75%, then that's overvalued. We would look to sell. And ideally, we align this tool with the trend. So undervalued readings are very powerful with uptrending markets, and overvalued readings are very powerful with downtrending markets. And that's also how we'll look at it. And the backtest that we'll show later is also going to that this is what we want to do. Now there's another very rare and strong setup in the market that can be found when looking at this tool. And that's a very interesting setup that we'll also spend a little bit of time on later on when we go into the charts, but already we can look at this here. At times, we will get undervalued readings. And at times, we will show consistent undervalued readings, even though price is rallying. So here for almost an entire month, we were undervalued on the Nasdaq, which means that for an entire month, you want to look to buy. What this tells you is that this is not a technical indicator, okay? Technicians have a way of using oscillators in a way of arguing overbought and oversold, okay? And how they do that, they will just look at the technicals, they put a statistical formula behind that, and they will say, based on the history, this is an extended move. But the problem with just looking at price and not looking at bonds as well is that during a condition of a strong uptrend, what a stochastic or any other technical oscillator will do, technical indicator, is you will be overvalued most of the time, right? And very rarely you'll be undervalued. Now, what these examples show you is that when price rallies and we're still undervalued, it shows you and it proves to you that this is not a technical oscillator. It's a fundamental setup tool. As we look at the relationship between this market and bonds drive stocks. Interest rates drive stocks. Okay, and you can see here price rallies, and as price rallies, we continue to be undervalued, and that is a very strong setup. Any technical oscillator in this world would have shown you an overbought reading there because price rallied. Price went into a new high. So how in the hell can we buy? Well, we should be buying because interest rates are telling us that even though we've rallied quite a bit, we're still very much undervalued. And this is a very rare setup. It also happened here where we rallied. And while we rallied, the indicator went into an undervalued, right? So it goes against price rallies, and then we get undervalued. Okay, we're about to break out into a new high. Okay, so these setups, these are the rare and the strongest setups that we can find. And how can we put this into writing? Well, we could say, well, if we see strong price plus undervalued, man, we really want to buy. If we see weak price plus overvalued, man, we really want to sell. Okay. But we'll do plenty of practical applications here. So we really have three setups that we can find. We have one, the end of the band on weekly, 13-week cycles. And then we have two setups on the daily, 10-day and 30-day cycles. And one is with the trend. Well, the second setup is then with the trend, and the third is also with the trend, but it's in line with already rallying or declining prices. Okay, so it's almost like buying into a new high or selling into a new low, which then in terms of the timing is going to be rather tricky, but in terms of the setup and the forecasting, this helps us a lot. All right, so what I want to do with you is I want to do a back test on Apple, okay? And I want to load the valuation tool for the first time, and I want to show you how I set it up. Okay, so you go to studies, add study, and then you're going to add your campus valuation. The newest version is V2.2. You're going to add that, and now you get this picture right here. You will notice that mine looks slightly different, so I'll show you how to change yours as well. When we double click on the indicator, we'll go to its settings. Okay, how can I also go to its settings? I can go to right mouse click, studies, edit studies, and here I can remove indicators and I can turn them off and I can turn them on again. And when I turn them off and on, they will disappear or reappear. Studies, edit study. Now, if I click on this one and I go to customize, now I'll also have the inputs customize window, just as I would get it if I just were to grab it and then double click it, I would get the same. So the double click is really a shortcut, but if you ever don't really manage to grab it, right? If you just click on the window, if you just go to customize windows and you don't really manage to grab it, sometimes this happens, you can always go to even up here, studies, and then also edit studies. Customize, now we're within the input settings. So we now have a couple of reference symbols. And at the moment, we just care about reference symbol 1, which is going to be based on @US. Those are the treasury bond markets. Those are our interest rates that we want to relate to our infinite markets, our stocks and equities. Later on, we can also use other storehouses of value, the ultimate storehouse of value, like gold, for example, to get a sense of value as we relate that to commodities. So we get cross-market conditions as we look at storehouses of value, right? Most things are priced in US dollar, but based on other storehouses of value, like bonds, for example, they're a storehouse of value, 30-year maturity treasury markets here, they are a storehouse of value. Gold is the ultimate storehouse of value. We can look at potentially relating this to commodities, and we can look at the US dollar DXY, to get a sense of value when we look at our Forex markets. And in fact, we could look at all of them combined. So show reference symbol 1, true, show reference symbol 2, which relates to gold here, could put that on true, show reference symbol 3, I could put that on true as well. And if I did that, you will see now 3 lines here. And those 3 lines would now be all of our cross-market conditions. And sometimes they'll move very similarly, but they don't have to move similarly. Sometimes they can be very different. If you look at euro, for example, at times we have one that's going to be undervalued and the other that's going to be overvalued, and one that's going to be in the median. Sometimes all of them 3 would speak the same language, and so on and so forth, right? So we'll put some rules around what to use, when to use. For the moment, as we are talking about stocks and equities, equity indices only, I can put a false on gold and I can put a false on the US dollar, press OK, and now I just have our interest rates. Now here you have length, okay, and length, that's the representation of cycles, and this is always going to be based on the time frame that you're operating in. So if you're operating on a weekly time frame, you want to change that to 13 because you want to work on 13-week cycles, and that would be 13 bars, so 13 weeks in the case of a weekly candlestick chart. And if we do days, then we can do 30 or we can do 10. I just like to do 30 for now. And I want to look at Apple as a case study. And I want to go some time back. And before I do the back test, what I want to do is I want to also show you some other things. So down here, we can change the color of our reference symbols. So what I have on interest rates, I have white, but because I have a black background, I can use white. If you have a white background, then you're better off leaving it as blue or as Dodge blue as a default. So if I put white here, then this line here, this oscillator would also change to white. Here you see it. And then I could also go to the color and the style. And on the style, if I look at, for example, my lower and my upper threshold, I could make them a bit bigger. I could set that as default. Right now it's a bit bigger. I could also make the diff 1, which is the reference symbol 1. I could make that a bit bigger as well, a bit thicker here. And then I could also say, well, what about the 0 line, which is the median? I want this to be dotted. And I want to put all this as default. Now you have it dotted, and now it looks exactly like I have it on my screen. Okay. That doesn't mean that this is, this is just visual. You can set it up however you want. You could make this magenta, you could make this pink, and this is up to you. But if you want to have it aligned to me, then this is what these are exactly the settings that I have. So you click default here. Okay, now if I remove it, and I'm adding this again, second. It should show the same on color on the inputs. I believe I didn't put a default here on the settings. So yeah, white and then 30. And now I forgot to put a default here. Okay. And now if I remove it and I add it back, now it will look the same all the time, right? So in fact, all of the indicators, you can create your default version, your standard version, and then when you remove it or when you create a new window, you don't always have to change the settings. But on all of these different sub-tabs, whenever you change something, you have to press default first before you move on, because that default is going to be different lines within the code than these default settings. So I guess you would have to press here default on all of them. Okay, so now we have it. Now we're looking at reference symbol 1 at US. We can see it also displayed here at US. And we're looking at a 30-day cycle right here. Okay, perfect. We have the upper threshold at 75%, the red line, and we have the lower threshold at -75%. These I could change as well, right? These I could change as well. However, for the beginning and for the most part, you would leave them as is. All right, so now we're looking at Apple Daily. And then what we want to do, of course, is first, we want to establish what the trend is, right? And I think without putting in lines or anything, we know this is an uptrend, right? So we know this is an uptrend. So we could start, for example, we could start from here, we could start from here, we could start from here, but let's just start from the first undervalued reading. And then we look at overvalued as well as undervalued with the condition of an uptrend and or overvalued with an uptrend, which then would be counter trend. We see the accuracy of that. And then as we move along, we may also look at, okay, how well do our undervalued readings and overvalued readings work when the trend is potentially shifting, and so on and so forth. Okay, so then we could also look at 10-day cycles and 30-day cycles. So we just have to start at some point. So if we want to start here, right, and we want to start from left to right, then here's the first time that we're undervalued. Okay, so we're in an uptrend, we're undervalued, and even though price is rallying, we remain to be undervalued for a very, very long time, which just means that we want to buy, right? However we can, we want to buy weekly demand, daily demand, we want to buy with the trend, and that eventually sets up pretty nice rallies here. So this for sure overall is a good setup. Then the next time we're undervalued is about here. This as well sets up a very nice rally. Then we're here. From this point onwards, we're undervalued here as well. Set up a very nice rally. Then we are undervalued again, starting from here. And we stay undervalued again for quite some time. And then we also get a very nice rally here. Then we're overvalued. And we can see that the overvalued reading doesn't really produce a big decline. Eventually it does, but we push higher, higher, and then only it declines. And then only after some time, we go undervalued again. And then again, this turns out to be a very nice setup. And then we're overvalued. This doesn't work. And then we're overvalued again. And this works pretty nicely. And then we're undervalued again here. And then here also we get a nice push higher, all the way from 150 to close to the back to the all-time high. So also this is a pretty nice rally here. So now we have within the uptrend, we have 1, 2, 3, 4, 5, 6 examples. So as we're looking at Apple and we're looking at an uptrend, we're looking at undervalued, and we're looking at trend following strategy, and we're looking at 30-day cycles. The action is to buy where in weekly and daily demand, when seasonality. So we looked at one, two, three, four, five, six. 6 winners and 0 losers. So basically 100% accuracy. Now, if I'm going to look at overvalued within a trend following setup, and I'm looking at the 30-day cycle, and I may be buying in weekly and daily, maybe selling in weekly and daily supply, then we can also count how many times it worked and how many times it didn't work. Okay. It didn't work. It didn't work. It didn't work. Eventually it worked, but I would count this as it didn't work because we would get pretty much knocked out a lot. So 1, 2, 3. Here, it also didn't work. It also didn't work. It also didn't work. And then eventually it's kind of working. So it works once from 1, 2, 3, 4, 5, 6, 7, 8. Okay. So we have 7 losers and 1 winner. Wow. And already what do we see is that when we look at the 30-day cycle, we see that, well, we really want to use the trend following strategy with the trend, right? We would be completely missing the point if we were to use this tool to predict a counter trend trade, especially in stocks. It's rather difficult to predict counter trend trades. So of course, it makes sense that trading against the trend, especially on a product like Apple, doesn't make a whole lot of sense. So we probably don't need to do a backtest to get to an understanding here that this is the case. But then all of a sudden, moving on, as we get lower highs and lower lows, eventually we're at the downtrend. So now let's just remove everything that we've had. Now the trend condition is going to change. So now we're in a downtrend. We're undervalued. Okay, you can say this works or this doesn't work. For sure, if we buy in a level of demand, we get a nice rally eventually. So we could say here, for example, if we had bought this here, then for sure it didn't work. So I'm gonna make this red, and then we're undervalued again. We go lower into demand, then it works very nicely. So here it would be green. So we're looking at undervalued first again, and then we're going to look at overvalued with the downtrend. So here, undervalued, it didn't work. Then we were undervalued again. This is all the same undervalued reading. So eventually we get a push, but we say this doesn't work. Then we're undervalued again. We go lower, and now we get a nice push. So this one works. Then when are we undervalued again? We're undervalued again here. Also doesn't work that well. And then we remain undervalued for quite some time. And yes, of course, eventually we get the push higher, but I would say this does not work very well. I cannot say, well, here, look at this undervalued reading really worked, right? Well, if we look at from left to right, then we start to be undervalued here, and really it didn't work that well, right? Because we first get knocked out, and then eventually, yes, we get it, but I would rather state this as a red one. So within a downtrend, and there are very rare times that we can find a downtrend, and this is all the trend following because I'm on the 30-day cycle. As I look to buy, then 1, 2, 3 times it didn't work, 2 times it worked. So also not the best accuracy here, right? Also not the best accuracy. But again, here we're going against the trend, right? We're going against the trend. Now, let's say the trend shifts. Now we're going to look at overvalued readings. Overvalued reading right here. And what is it that you can notice here? And that is setup number 3, the very rare setup that we have to pay really, really close attention to, because we're not overvalued here, right? We're not overvalued here. We're overvalued here as price already declines. So market red setup 3, weak price plus overvalued. That is a very rare setup. That's part of the trend following. You can cluster it in the same one, but you'll notice that when you get those setups, man, those are really, really crucial for us to pay attention to, because price is already declining for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. For 2 weeks, price is declining. And what is happening is that within that time frame where price is declining, the oscillator goes into an overvalued reading. So it really means that the spread between the bond market and Apple here is increasing dramatically, more so than even the decline of the market. And so this really means that that we're about to see a major setup in the marketplace. So here for sure, there's no two arguments about it. This worked extremely well. Then we're overvalued again. And here as well, I would say maybe it worked and it didn't work, right? Eventually, this was the top of the top of the top, but just too early, right? Just too early. We may get knocked down once, but here the difference on how too early it was is not, it's not that bad. We did get here overvalued, and then it just took some time for price maybe to find some weekly supply and then to go into that decline. So we can put a red here to say, well, for sure, we may have gotten knocked out once, but then as we continue to sell this, eventually in weekly supply, we would really have this trade here. We could really sell this to the downside. Then again, we're overvalued here. And here as well, we do get a little bit of a decline, right? For maybe a few days, maybe 1 week or so, but we can see the trend has shifted, okay? So it's going to be interesting what happens at these scenarios here, where then the trend is shifting, but still, if we play an overvalued setup here within supply, we may have gotten, a little bit of a push lower. Not too dramatic, but a little bit of a push. So we can see that it worked 3 times and it didn't work once. So downtrend, now we're looking at overvalued, trend following, we're looking to sell in weekly and daily supply. And then it worked, we said 3 times, I think, and it didn't work, I think, once, right? And so we can see that when we applied with the trend, those are our highest accuracy trades. When we applied against the trend, then those are our lowest accuracy trades. So the question is really, what happens at these scenarios where maybe the overvalued starts to work, or maybe now the undervalued starts to work only here, or it starts to work only here? What is happening in terms of the valuation in those specific times, in those specific instances, right? And so what we have to do here, or what we can do, is we can just move to the weekly. And as we move to the weekly, what we would also do is we would look at a 13-week period. Okay, we would look at a 13-week period. Now, the trend on a 13-week period, I think, is pretty clear. We don't have to go into a lot of detail here, but what we can say is that when they set up, right, and here again, sometimes early, but when they set up, in the long run, these are very good buying points. So this is a good buy point. This is definitely 2 or 3 weeks too early, but as we can be too early or too late on the daily cycle, up to 5 days too early or up to 5 days too late. Here, we may be up to 5 weeks, well, 5 weeks, 3 weeks early, right? Before we then get a rally. And of course, this is now comprised, right? However, this would still be a major rally here, looking at the percentage moves. And this is a major rally looking at the percentage moves as well. And here it works even a lot better than here. But whenever we get undervalued readings, here as well, maybe slightly too early, but eventually Here, this was the Corona crash. Here we were bang on, just absolutely predicting the low of the low on the Corona crash. Then, now we're talking, right? Now we're talking. The undervalued works really well once we're also undervalued on these really high cycles. So here eventually, and here eventually, these are major setups, just like this was a major setup, just like this eventually was a major setup. And all of these in my books, well, this would be one, all of these in my books are going to be green. Why are they going to be green? Well, we would always trade in the context of a downtrend probably. So the trend condition here is tough because this may be a downtrend on the daily, this may be a downtrend on the daily, this may be a downtrend on the daily, right? So these weekly setups, as we go to the daily, if we argue a daily trend, it would be a counter trend, but as we argue the weekly trend, this would still be an uptrend, of course. So depending on the time frame that you're arguing here, as always, the trend condition could change, but let's just say this is a downtrend because it's our end of the band strategy, and it's based on 13-week cycles. I'm looking to buy. Well, here I'm not buying a daily. Here I'm buying the monthly, right? Because these are longer term setups. And when we buy the monthly, and we could go maybe as low as the weekly, but if we buy the monthly, then these setups really work very well. Then it doesn't matter if we set up too early, because anyways, we will then only buy within monthly demand. And then eventually, if you look at the tool here, we would get 1, 2, 3, 4, 5, 6. Let's say this one didn't work, right? Because we also didn't get much of a rally here. So once it didn't work, and then 1, 2, 3, 4, 5 times it worked. So here we have a very high accuracy, right? Here we have a very high accuracy again. And these setups that we get, they are very rare. So if you, for example, want to be a value investor, right, then you may ask, well, how do I get a sense of value in stocks? Should I look at dividends? Should I look at PE ratios? Should I look at sales to whatever ratios, or debt to equity ratios, or whatever else is out there? Well, you can simply look at the relationship of the bond markets and the stocks you love to trade. And if in your back test, you see that it's true that whenever we're undervalued, sometimes bang on, like during the Corona crash, bang on, or sometimes a few weeks too early. If you're in the game of long-term investing, these are the setups that you really want to pay attention to. And these would give you major buy and hold setups. But we could also, of course, not just buy and hold, but also use them for our trading as we then look at monthly demand. So when we then get these kinds of setups, and then all of a sudden I go to a daily and I'm also at some point undervalued, and I'm in monthly demand, then you just know that you want to buy, right? You just know that you want to buy. And what you could also do now as the next step is go back to the weekly. We could look at the overvalued readings, and we would get here it doesn't work, it doesn't, here it works. Here it maybe works a little bit, but not so much. And here also it doesn't work. And then here also it doesn't work. And then here it works bang on. So now it works. Now we're overvalued again. Well, doesn't seem like that's holding off very well, right? And so it worked once or twice out of 1, 2, 3, 4, 5, 6 times. Well, 6 times it didn't work. And then was it 2 times it worked? Yes, I believe so. So already, you know, for Apple, you really don't want to sell, right? For Apple, you don't want to sell. The only time you would sell is if you can predict a recession. But even then, we probably wouldn't sell Apple. We would sell some weaker markets rather than Apple. So during uptrends and overvalued, well, this would be undervalued. And as we look to sell in monthly and weekly supply, there's not a very high accuracy. So now we can argue, what are the strategies that we want to focus on? Well, I can tell you, we want to buy undervalued with the trend on the 30-day cycle. We want to sell overvalued with the downtrend, potentially. We want to look to buy when we get a 13-week undervalued reading as well. And what we don't want to do is we don't want to do anything against the trend. And we also don't want to look at overvalued readings on the 13-week cycle. We also really don't want to do that either, right? As we buy against the trend. So now we've got our action metrics. Now we know what to do and when to do, and for Apple. Now we could say, well, this, going back to the daily, we could say, well, this was the 30-day cycle. How about the 10-day cycle? Which one is better, right? Which one is better? Well, if we look at the 10-day cycle, then we get a lot more setups. We get one here that we didn't get before. We get one here that we didn't get before. And then here where it didn't work. And then here where it didn't work. And then here where it eventually worked. Again, within the downtrend, right? We get more. Here we get an overvalued. Here we get an overvalued. Here we're bang on again. And then here we're way too early. With the downtrend. So with the downtrend, it really seems like the 30 is better than the 10. But with an uptrend, if you're uptrending, then you can easily also use the 10. Here, though, on the 10, we're too early. We were bang on with the 30. Here, we're too early again. We were bang on with the 30. Here, it's bang on. Here, it's a bit too early again. And then here again, it's also a bit too early. So by just looking at this now, I know that the 30-day cycle that I used on Apple, right? So I move this here, much better setup. I even get a setup here that I didn't get on the 10. I get a setup here that's much better. Here as well. Then here, I get a setup here that's much better. Here again, if I move it to here, it's much better. And then here, it's also much better. So the 30-day cycle, there's no doubt about it that on the case of Apple, we should use the 30-day cycle. So now with doing this analysis, we have our cheat sheet, and now we can add Apple, and our primary fundamental setup tool for Apple is now going to be interest rates on the valuation. That's our primary setup tool. We can't look at the COT, right? COT is only for futures. And even if we could look at the COT, the major fundamental key driver for stocks is just not the users and producers, right? It just ain't so. It's interest rates that drive those markets. We know that. And so therefore, we know that we saw that. And therefore, this becomes our primary setup tool. And what did we really learn about it, about Apple? Well, we learned that 30-day, the 30 cycles, trend following, and 13-week cycles. Let's maybe put this 13-day cycles and the 13-week cycles, trend following regardless, 13-week cycles only with my buy setups. Okay, so buy and sell, but buy a lot better. On the buy, we had 100% accuracy. On the sell, we didn't have 100% accuracy. And on the 13-week cycles buy, this is really a longer term play, right, within monthly demand. So now we have a beautiful rule on Apple. So also that tells us, hey, if that's the case, what am I going to do if this ever becomes undervalued again? And it's quite interesting what's kind of happening here as well, right? As we're rallying, we're becoming more and more undervalued, and we're at the median now. It's kind of interesting. Eventually, it may take some time, but eventually we will get undervalued. And when we're undervalued now with that uptrend, guess what we're going to do? Well, we better buy Apple, right? Whether we buy it for the long term, whether we buy it for the short term. In that case, it will then become very beautiful. A very beautiful setup for us. 10-day cycle. Also here, we're not quite undervalued, but still it's quite interesting how they're pretty aligned. But 30 here, you can see also it's a lot clearer here as well. A lot clearer. On the Dow, something happened that's very interesting. I have a question here. Let me just read that question out, and then we will move on to what I had planned here on the Dow, and maybe we look at other stocks here, other infinite markets here as well. So Cervantes is asking, let me just read that out for everyone that's maybe watching the recording. What if we get, I quote Cervantes now, what if we get a undervalued reading in an uptrend, but we have no demand on monthly or weekly, for example, but we still want to buy? Then we just use the price action tool. Example, bullish hammer engulfing. This still would be okay then, right? Exactly, right? You're absolutely right. You're kind of stealing my thunder, my future thunder. In the future, well, what we haven't talked about is timing yet, right? We're just speaking about the market setup. We're just speaking about how to forecast. When it comes to timing, we have two timing strategies here. We have the supply and demand, and if you don't find it on a monthly or a weekly, then maybe also a daily, right? And on price action, you also have rules to enter potential trades, trend line breakouts, hammer candles, engulfing candles, you name it, right? Toby's creating a nice course at the moment on all these price action scenarios that you could take advantage on. And then on top of that, you will have the trading software that we developed, the trade optimizer, that is also going to give you entries based on not visuals, not technicals, right? Visually analyzing the chart, but based on a huge data collection. And based on the data collection, it's then going to tell you, well, what's the best day of entry? What's the best entry price, what's the best stop loss, what's the best holding period, what's the average expected profit, what's the max expected profit, right? What's the ideal stop loss in terms of the max drawdown or the average drawdown, how many winners, how many losers. And so with the trading software, with the Campus optimizer, you'll have a third way of potentially then getting into those markets. So you'll have supply and demand, and then you have the trading software, and then this will be more towards timing, okay, timing the market. But you're absolutely right, Cervantes, and this is then a more advanced conversation that we're going to have after the fundamental setup is, if these markets set up fundamentally, how are we going to go about the timing? And then even if we do all the forecasting correctly, this is also where we can be wrong, right? So let's say we forecast something correctly, but we're too early. We forecast something correctly, but we're too late. We don't get in. We forecast something correctly, we get in, but the risk to reward ratio maybe is not that great because we just had, the zone was just too large. Or maybe, you know, the ideal scenario is we are forecasting something to happen and then we're timing it in a way where we don't just forecast a rally or a decline, we also manage to get in and out of the market accurately with a high risk to reward, ratio, right? And so this is where then the conversation is going to become super, super complex. And in the case of Palladium, for example, that we looked at a long time ago, and when we said, well, this is, you know, we said this is going to set up for a rally, and then when we have the rally set up, then look, there's going to be multiple ways on how to enter this. We can trade the monthly demand, right? We can trade the weekly demand, or we can then trade the daily demand, and then again the daily demand, and now again the daily demand that is being set up, right? So now we're just trying to do our best to get in and out of this market with our supply and demand set of rules, with our price action set of rules. Maybe you see an engulfing candle here somewhere. Here's a hammer candle. You enter on the hammer, then you take some heat. Then maybe you do another daily reversal, and so on and so forth, right? So then there are endless possibilities on how to time the markets. Then you could also say, well, what we also talked about was, there's this neckline. If this neckline is going to get broken, then the neckline is broken, then you trade the breakout. Then the question is just, okay, where do I put my stop loss? Do I put it here, or do I just use maybe a few candles, the few candles to the left here? And there's not going to be a right and a wrong here. And that's why I'm covering technicals and the art of timing the market very last, because that's going to be the more abstract and the more it depends analysis, right? Are you a more aggressive trader? Are you more conservative trader? You like to trade weeklies, you like to trade dailies, you like to do trend line breakouts, you like to trade price action. We all approach the market timing very differently. However, at this stage, right, so how we then approach that market timing, that's going to be very different. You may trade the monthly, you may trade the daily, you may trade the breakout, you may trade now the pullback. However, what that's going to be subjective, even though the set of rules are, everyone is always saying technicals are so objective, right? But when we talk about entering and setting a trade, that's not objective. That can't be objective. You see different things that I do. You are maybe more conservative than I am. And so that may vary. So the trade outcomes also may vary. So that's more subjective, even though we're always taught that that's the objective way to do it. What is objective, however, and where we all should be on the same page, right? Where we all were on the same page when we looked at Palladium on the weekly, and we looked at our COT index, and we looked at the commercials versus the retailers. And that's the beauty now about those lessons. The further we get along, the more, you know, we can jump back and forth and see what we're going to do, when we're going to do. We can talk about not just valuation now, but we can also talk about the COT. And here, for example, you know, we should all have the same understanding that, and I can even put the commercials here as well. Users and producers. We should all come to the same conclusion that as the commercials are at a historic high and touching that yellow line and the retailers are selling, we should all come to the same conclusion that we want to buy. Okay, we want to buy. What are we doing? Well, we are predicting A to B, right? And that A to B, as we're predicting that, there's going to be multiple chances to get into that trade with price action, with trend lines, with pullbacks into demand, and so forth. No, Cervantes, that's a very good question. I like it. This is also for those of you that are more advanced in the room, always feel free to ask these kinds of questions, right? That's why we're doing it live. That's why we're doing it live. So just remove these drawing tools here. All right, so moving back or going back to now the Dow. What happened in the Dow, something that happens very rarely, is again, as we look at the 30-day cycle, is that for a very long time, we stayed undervalued, and we're still kind of undervalued, even though price rallied. So that tells you a lot about how strong this market is at the moment, right? And we may get pullbacks, but if we get a pullback, we definitely want to buy those pullbacks, right? There's not going to be two opinions about that, right? And whatever it may be that you're looking at least from here, at least in this time, if you're telling me you want to short this, then you're missing the point, right? In this time, all we can do is we can look to buy. We can look to buy with price action. And again, we can look to buy with supply and demand. It really doesn't matter at that stage. We could also look at the Nasdaq. And we could do a similar back test that we did for Apple. However, the results that you will get are going to be very similar, where, of course, also Apple moves kind of similarly to Nasdaq, right? Apple has a high weight within the Nasdaq. So the readings that we're going to get here in terms of undervalued, then we stay undervalued for a very long time, and then eventually price just absolutely takes off. Here price rallies, then there's the very rare setup where price rallies and we're getting undervalued. Really have to pay attention to that. Within that uptrend, undervalued, rally. Here again, we get that rare setup where price is rallying but we're getting, again, we were undervalued here, but we're getting again undervalued, right? We're getting again undervalued. And then we're undervalued here. And we stay undervalued. Again, very rare setup. We go into all-time highs, and then we get that rare setup again. And so it's going to be very similar on how this works, as we saw on Apple. So as we did with wheat, I'm not gonna do all these markets the same way, right? I'm not gonna do the same back tests here on all the markets. I did one to kind of show you also, okay, how to potentially do that on your own, and then how to come up with a strategy where, when do you want to buy based on the cycles, based on the trend following or the end of the band strategy. And then you can put it right here. But for the most part, our stocks will fall into this category. And our stocks will fall into this category. This is going to be our primary setup tool. We're going to look at 30-day cycles, trend following, and the 13-week cycles as a buy here as well, also for the Nasdaq. And here, bang on, here, bang on. Here, definitely way too early once, but then eventually we get it. And then here we get a little bit of a rally, and then we just continue to go down and we remain undervalued for so long. So maybe here, not such a great tool to use, right? As we look at this, we were undervalued way too early. Here it worked well, here it worked well, here it worked well, here it didn't. And then here it worked for a little bit, and eventually it worked here as well, but it took a lot of time for this to really play out. And so you could say that for the Nasdaq, you can still look at this, but it doesn't work as great as, for example, as it did for Apple itself. So again, all markets are going to be slightly different. Not all markets are going to be the same on how they will set up. Dow Jones. 1 second. I think I messed up on the Nasdaq as well. It should be 13. So Corona here as well, also here too early, but eventually we got that rally. Here it was set up very nicely. Bang on, bang on, bang on, bang on. Too early, but then bang on. Here also Corona, of course, a bit too early. It just all happened way too fast, but then bang on. Here, bang on. And then we came down again. Did slightly new low, but this one worked for many weeks. And now here again, right? Here again. Very interesting. The low of the low that may create now eventually a new high, right? So on the Dow, we can already say that we can already say, hey, here again, we want to use the interest rates and we want to use supply and demand. And we definitely want to look at the 13-week cycles, buy points. They are super accurate on the Dow. The Dow is, the true representation also of the US economy. So that's why we love it so much. It's a lot more predictable than NASDAQ. And if I go to the daily, what you will find is that on the Dow, the 30 cycle works pretty well as well. But the 10 can work a lot better, right? So sometimes here we're undervalued, we get a rally, and here we're undervalued, we get a rally. Then here we're undervalued, it does not work. And I'm now looking at here we're undervalued again, it also doesn't work. So that's the same undervalued reading potentially, right? We're here it doesn't work, or we're too early, whatever you want here, but here we're undervalued. That works very nicely. Then here we are undervalued. That doesn't work. Here we're undervalued. That works a little bit, but not so much. So these ones don't work. So again, your results that you're going to get, they're going to be similar. Why don't they work that great? Well, because we're making lower highs, we're making lower lows. This is a downtrending condition. So these just naturally will not work as well, right, as the trend is down. Here, I would say still, this works out pretty nicely. And then just beautiful here. And then just bang on. A little bit early, but bang on. Bang on. Bang on. Right? Bang on. So again, within an uptrend, oh man, right? These are just beautiful setups in the marketplace. And here we can also use the 10 cycle. Let's just look at the 30 once more. See if something changes. The 30 here, we get another setup here. And in fact, here on the 30-day cycle, we are just undervalued for so long. It's just buy demand, right? Just buy demand. Whatever you can get your hands on, just buy. But on the 10, you can see that on the 10 during this time, we were a lot more accurate because we could see the dips much better than on the 30. Right here, we're the same. Here, we're the same. So as we go into the downtrend, then of course the 30 are going to be a little bit more accurate than the 10, as it takes longer usually for us to be undervalued. So, and here as well on the 30, beautiful undervalued reading. And then it didn't work. And then again, it worked 2 times. And then here we stay undervalued for a very, very long time, which is again that exception. So for the Dow, I would argue, well, in reality, what we want to do is we want to look at the 30 and the 10-day cycles in trend following. And we want to have both kind of on the radar, right? We want to look at both. We don't just want to look at one. As we understood on Apple, it's fine to just look at the 30. As we look at Dow Jones, we want to look at 30, we want to look at 10, and we want to look at the 13 weeks. And then on NASDAQ, the 30 is also better than the 10. And what my plan is, of course, is eventually, as we can have, very comprehensive discussions together in also backtesting, we can then look at all sorts of markets and at all sorts of fundamental setup tools. And then we can argue, hey, what works and what doesn't work? What's the best strategy to use for each of our markets that we love to trade? Microsoft, for example, right? How many times does it work? Now we're up. Now at this point, now we're uptrending. If we get undervalued, we know what we want to do, right? We know what we want to do. And then here, even it worked a little bit, even against the trend. So, and then here we were just little bit, and then the trend is shifting. And as the trend is shifting, of course, the undervalued readings will not work. That's just how it is. That's how it will always be. But let's look at the trend. If we're uptrending, undervalued, undervalued, and look at how long we stay undervalued for. Undervalued, undervalued, and then we stay again undervalued for a very long time. And so all of these again within that uptrend, very high accuracy, beautiful. Even against the trend, as the trend is shifting, we're gonna get knocked out, right? As we may not predict the end of the band here. It's almost impossible to predict the end of the band. It's not impossible, but it's improbable unless we can predict the recession, which we can do very rarely. And then as the trend again is kind of shifting, these undervalued readings, they will start to work out very, very beautifully. So here we had a 13-week undervalued reading that predicted the end of the band. We had one here that got us a nice 1 or 1.5 months rally. We got one here that predicted a nice 3-week rally. We predicted the low of Corona. And here we stayed undervalued for a very long time here as well. So the question here is again, right? If you want to be a value investor and you choose your markets, whether they are Apple, whether they are Microsoft, whether they're Google, and you look at this and you may say, well, here I'm going to buy, here I'm going to buy, here I'm going to buy, here I'm going to buy. You eventually, in the long run, there's not a whole lot of things that can beat that. Then if you, of course, overlay monthly demand, right? If you're going to say, now I only want to buy in monthly demand, right? And you start buying here and you start accumulating here in all of these monthly demand areas, then eventually, right? Eventually you will have maybe a better entry as if you just buy as a value investor, as a long-term investor. But in terms of understanding what the market is going to do, that is going to help you a whole lot also on the investing front, because if you are going to argue a recession, right, as we talked about 2023, and when we looked at our yearly roadmap, and now as we talk about stocks, I have to quickly show you what I mean by that. And then we're going to end it with that maybe as well. I'm going to tell you what the next lesson is going to, what we're going to cover in the next lesson. So within the classroom and within the OTC stock investor, what you will have is at the end, you'll have a stock market forecast. And that's our 2023 forecast that we do once a year in the beginning of the year. And here we argue whether we take the stance of, is this going to be a recession year? Is this going to be a bullish year? What are good months to be a buyer? What are good months to be a seller? And this is important for us, not just for the value investor, for the long-term investor, but also for the ones that want to take advantage of these huge swing moves in trading as well, be it daily income or weekly income. And so what we said here is that we do not, right? What we said here is basically that we do not predict a recession. So in fact, what we said, the beginning of the year, we said is going to be a blow-up rally, right? We said it's going to be a blow-up rally. So if you're in 2023 and so many people were arguing, well, the whole world is going to end in 2023 and recession and whatnot. If you're going to look at the most important market, the most important stocks that drive the equity indices, and you look at 2023, we were undervalued across the board, right? And so the beginning of the year from January, blow up rally all into April, May. And then you can see, well, what actually happened rather than us getting a recession is, well, we got the blow up rally. And so why did we get a blow up rally? Well, because in the context of interest rates, we're undervalued. It's nearly impossible, never say impossible, it's very improbable that we're going to get a recession during times of 13-week undervaluation. We may get a little bit of a further decline, yes, but what was very likely is that we would get a blow-up rally in the beginning of the year, right? So a good time to buy, even if you're going to ask, well, it's a downtrend, we're making lower highs. Yes, but we should still buy nonetheless, right? We should still buy nonetheless. So that is also something that's going to help us with that. My plan eventually, as we cover all of our forecasting tools, my plan eventually is that on all the markets that we cover, S&P, Nasdaq, Dow, gold, silver, crude oil, natural gas, on all those markets should be covered here, right? For all those markets, we should know what's the primary setup tool, what are some specific things we want to watch out for, what are potentially odds enhancer for a specific market, and what are secondary setup tools. And that we haven't even looked at yet, right? Because now interest rates or valuation could now be, as we look at gold, for example, could now be a secondary setup tool for palladium, right? So we can look at the commercials, but we can also look at gold as a cross-market condition to value palladium. And or we could look at, as we looked at the non-commercials here for the JPY, we could look at maybe the US dollar here. And the US dollar may be against euro, maybe number one, maybe a primary, as well as the non-commercials. And depending on how well this works, we could even say, well, this is the primary and this is the secondary, because these are very rare setups. So for all of the markets that we cover, I want to create this sheet, this blueprint cheat sheet, right? And this is something that you want to maintain for the rest of your trading career, because all your key learnings, and you could even put more, you should put more additional notes here, right? Because a lot of things that I'm saying, I'm not even writing down, but a lot of the things that you're learning as you go, you want to write them down, right? If you see the commercials net long as the ultimate buy signal, and if you, for example, for the Nasdaq as a primary setup tool, we just covered that quickly, but we're gonna cover that in more detail as well for Apple or for Nasdaq. You know, the yearly roadmap. Oh my God, when I do this, I really have to check the yearly roadmap, right? If we're predicting a blow up rally in the beginning of the year for Apple, and I'm looking at 2023, and in 2023, we're undervalued against the 13-week cycle and we're predicting a blow-up rally, then I better want to buy that, right? I better want to buy that. So eventually what this is going to do, and I think the best analogy here is, even though I'm not a chef, right? My family back home, they own a family restaurant and a hotel. And the best analogy here is a good recipe, right? If you go to a restaurant and you eat something that tastes very nice, there's not just one ingredient in there. There's going to be multiple ingredients, but there's not going to be all ingredients all the time. Depending on what you cook, there's going to be different ingredients that will spice up that food. And we also don't want to be, too many different ingredients, just the perfect amount. So there's a very fine line between what do we want to do, what's really important to look at, and what can we just avoid or neglect and save some time in moving on and focusing on some rather than others. So today we looked at interest rates and we looked at stocks versus bonds. Those will be our primary setup tools for our equity indices and stocks. And next time, what we're going to do is we're going to look at commodities and gold, and we're going to look at Forex and the US dollar as well. And we may be able to do that in one, and then we can do some practical applications, and then we can also move on to the true seasonality after that, so that you have a primary setup tool for our finite markets, you have a primary setup tool for our infinite markets. Nonetheless, the valuation can be the secondary tool for finite markets, and the COT can be the secondary tool for our infinite markets. And then the true seasonality we will cover on all markets as well. And after that, we're going to go back into supply and demand. All right, that's all from my side for today. Thanks for watching. Thanks for staying until the end. Feel free to stay online if you have some questions. If not, thanks again. Ciao, and I'll catch you all in the next few days.